Are you looking to invest like the professionals without the buyer's agent price tag? DIBA helps you save time and money by filtering out 99% of markets within Australia to give you the top 1% of Australia's suburbs set for strong returns. The do-it-yourself buyer's agency save you thousands on buyer's agent fees and months on courses. Instead, for a fraction of the price, you can search for highest performing markets, target the right property for your investment goals, and be guided through the purchase process. DIBA, the ultimate tool for the everyday investor. Sign up at www.diba.com.au to put the power back in your hands. That's www.diyba.com.au.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hello everyone, Grace Ormsby here. Welcome back for a brand new episode of the Smart Property Investment Show. And spring has most certainly sprung. So to get a bit of the rundown, a bit of the lowdown on what is going on in the market at the moment, it is an absolute pleasure to welcome back Eliza Owen, the Head of Research at CoreLogic Australia, to today's show. Eliza, I always love chatting with you. Thank you so much for taking the time today.
Oh, thanks for having me as always. Great to be here.
What are you seeing with your very much helicopter view of the Australian market and data and research, and you're very much in the know of what's going on week in, week out? What are you seeing for this first week of spring and just that kind of sentiment that's going around at the moment? Because it has been an interesting one. We've obviously come off the back now. We know what the RBA's position will be heading into spring. They've made the decision to keep the rate where it was for the second consecutive month. So yeah, what's going on? What are you seeing? What are you hearing in your circles?
Yeah, I mean, it's a bit hard to read the past few months, but if you were to ask me where we are right now, it seems like we're into a pretty strong start for the spring selling season. New listings have been rising. They've actually been rising through winter, which is pretty weird. You wouldn't normally see that. These new listings have been quite well absorbed by sales volumes. For the week ending 3rd of September, the clearance rate was sitting pretty firm at just over 65%. And the 4-week average final clearance rate for the combined capital cities is just over 66%. So that's above the long-term average. Property prices continued to rise through to the end of August and start of September. For the past 4 weeks, we've seen an uplift of about 0.9% in the combined capital cities. So that's pretty good, that's coming off a recent low in July for monthly price growth. And I think all in all, it paints a pretty good picture for sellers. There are some headwinds that we've got to navigate throughout the rest of the year. And part of that includes the impact from cash rate rises that we've seen to date, where the RBA has been trying to slow economic growth. And that means a rise in unemployment, with the new RBA Governor, Michelle Bullock, reiterating the other day that she would expect the unemployment rate to get to about 4.5% before inflation is well and truly under control. So that could have flow-on effects for serviceability of mortgages and consumer sentiment and home purchases. But right now, I think we're in a pretty good position.
We're obviously not going to be we're going to be crystal ball gazing, basically. Don't take anything we say, even the fact that, COVID a couple of years ago completely changed the game and what to expect from there. But given what is happening with consumer sentiment at the moment, I'm very curious, because this is a podcast for investors, by investors. There's going to be a lot of people that are interested in what is going on at the moment and how the investors are actually feeling. What are you seeing from your perspective?
Well, we track consumer sentiment, particularly the monthly index put out by Westpac and the Melbourne Institute, because it correlates to sales volumes and is an indicator of demand. And surprisingly, that's sitting very low. It's sitting at 81 for August, which is around the recessionary lows that we would have seen at the onset of the GFC, that we saw at the onset of COVID. And that's sort of kind of counter to what we're actually seeing in sales volumes, where the two would usually track together. sales volumes across the combined capital cities, for example, over winter kind of normalized. So they're sitting a little bit lower than where they were last year and where they've been historically, but they're sort of getting back towards that longer term average. From the investment perspective, that's really interesting because if you look at ABS housing finance data, credit growth is actually being led by investors at the moment. So the growth in borrowing for property purchases has been growing a little bit more in the investor segment, whereas owner-occupier activity has actually trended a little bit lower through June, July. So the result of all that is that in terms of the mortgage market and purchases, investors make up a little bit more of that mortgage market at about 36%, which is sort of well above the decade average of where it would usually be. And it's particularly high at the moment across New South Wales. Investors make up about 40% of the mortgage market as of July, and Darwin, but that's a relatively small and traditionally more of an investor market anyway.
Okay. So I'm just thinking, and I'm putting two and two together here and probably honestly coming up with five. So feel free to knock back the assumption that I'm about to make. But do you think we're seeing investors maybe capitalize on a market that, you know, could have some headwinds still coming and the ones that are probably getting into the market now are probably a little bit more prepared. They know what's going on with finance. They sort of know where their boundaries do lie.
I think inference to make, and that's kind of one of the explanations that we could give for a property market that seems to be rising in value, despite the fact that consumer sentiment is low, economic performance is slowing down, and interest rates are still high. They haven't come down yet. So you'd have to imagine that perhaps because we have such a large variable mortgage market, that there is maybe a bit of speculation that because interest rates would move lower in 2024, that now would actually be a good time to get in from a capital growth perspective. If you can cop higher interest costs in the short term, you might actually be paying a relatively low price to what will eventuate when mortgage rates fall. Having said that, you know, I'm not saying that that's necessarily the right bet because economic conditions are still very uncertain. The direction of the property market is still a little bit uncertain. But then, you know, there are still always good opportunities too. If you look at Perth, for example, it's an area that's coming off the back of an extended decline, but value growth has been incredibly strong through COVID and steady since rate rises. The peak to trough decline in home values across Perth has been less than 1% since rates started to rise. And anecdotally, we're hearing that there's a lot of interstate interest in that market because it obviously presents a relatively good capital growth story, but gross rent yields are pretty good there as well, just below 5% across the whole Greater Perth dwelling market. So, yeah, that could be part of the investment growth and opportunity in the market at the moment as well.
Definitely some food for thought there. We're going to take a quick break. See you very soon for more from Eliza Owen.
Crush the burden of rising mortgage repayments. We understand that managing your finances can be overwhelming, especially as interest rates continue to rise. With access to 70 plus lenders, our team of specialised brokers will find the best rates for your specific needs. Count on us to secure a lower rate swiftly, giving you the confidence you deserve. Book an appointment with one of our experts today to protect your financial well-being and secure your future. Call us now at 02 8866 2444 or visit our website at finny.com.au.
Welcome back to this episode of the Smart Property Investment Show. We are chatting with Eliza Owen, the head of research at CoreLogic Australia. It's always amazing to get your insights, Eliza. So much is going on, and I feel like you do such a great job of cutting through that noise to give us some great insights. And one thing I want to pick your brain on, if you do not mind, is around the short-term resale data, because I do feel like we've seen so many people probably, beginning of COVID, prime example of the RBA coming out saying that rates wouldn't go up for a very long time. We saw that wasn't the case. We saw a lot of people buying in with that expectation. How are you seeing that particular data point show up at this point in time? Because I am curious. There's also the talk around the mortgage rate, the mortgage cliff, and what could be happening with that. And are we seeing any of that flow through to that real data?
Yeah, that's a great point. So part of the reason it's of interest to look at short-term resales is because, as you say, as people go from low fixed rates to high variable rates, there is this threat that people may have trouble servicing their mortgage and find a need to sell. So we've looked at the portion of resales that occur with a hold period of 3 years or less over time, and we have found that figure to be rising. But is it the mortgage serviceability issue? I think it's maybe more of a nuanced story. So across the combined capital cities, short-term resales hit a low at sort of the recent high of capital growth performance in 2021. Across the combined capital cities, it sat at about 9.2% at the end of 2021. It's since steadily risen through the start of this year to about 12%. Interestingly, for regional Australia, it's ticked up a lot more, sitting at about 18% of all of the resales in the regional market seem to be happening within that 3 years or less, which is huge, right? So it might not just be for sales or people worried about their mortgage. It might be demographic changes, people who maybe went to regional Australia and bought during COVID, and now they're finding, I don't need that regional escape anymore, that we're beyond lockdowns, or the mortgage is becoming more inconvenient on that property. We've also noticed a lot of that short-term reselling across Brisbane, which is up at about 16% in the 12 months to June. And that would be, just that capital growth conditions have been really strong across Brisbane. If we look at the listings that are coming to market, around 36% of new listings added to the market recently, we think are owned by investors. That's a really large portion relative to the pre-COVID average of about 25%. So when you put these data pieces together, it paints a story of, maybe it is investors who are more inclined to offload an asset where mortgage costs are rising, but also capital growth has been really good, and maybe it is a good opportunity to get out.
That's a really cool point to make, I think, too, as well, to everyone who is listening, that just because it looks like there's been this massive, I don't want to say issue, that's not the right word, but a growth in the number of short-term resales, it's not a bad thing. It doesn't have to be a bad thing.
Yeah. And I guess at the end of the day, we don't know, because you don't know why people are selling unless you ask them, right? So these are just inferences I'm making based on the current climate and different pieces of data that we're looking at. But even if you look at some of the official data around, say, mortgage arrears, the June quarter data was released this week, and even that still shows only 1.3% of outstanding housing credit was paid late. So obviously, people who are going to be struggling most with mortgage rate increases are limited to those that have a really high amount of debt. So probably people who have purchased within the past few years. But broadly, I think people have the buffers, the income growth and the savings to be getting themselves through this time. There is some risk that as the unemployment rate rises and as more fixed terms roll off at the end of this year and into next year, that we could see more arrears, more forced sales. But ultimately, between the data and some of the anecdotes we're hearing, it doesn't appear to be a massive portion of sales activity.
Let's turn our attention to the path forward from here, Eliza. Obviously, we still don't know what's going to happen, as I said before, crystal ball gazing here, but where are your expectations sort of towards the end of spring and summer, and then even towards 2024? Because everyone is pretty much in consensus that if we're not at the rate ceiling, we're very close to it. So we're not going to see much more upwards movement there. But where are you kind of expecting that next even 12, 18 months to go? And what could it mean for investors who are trying to work out what the best route is now? They're going to have to do some things now to then, have some expectation of what to do down the track.
Yeah. Like I say, the market is really hard to read right now. I don't think the trajectory of growth rates has been super clear. It started to come down in May, and then it started to tick up again just from this month. But I would imagine that upswing we're seeing at the moment is going to remain pretty soft and pretty tenuous towards the end of this year because spring is going to see more listings added to the market. Usually it also sees more buyers, so it doesn't have as much of an effect on price. Between winter and spring, you get about an 8.5% uplift in sales volumes on average. So the question is, this spring, as we've started to see new listings rise, are we going to see a comparable lift in demand and in sales? I'm not sure that we can because affordability is constrained, interest rates are still high, and those people who have been buying at the moment are probably less reliant on credit, but who knows how many more of those kinds of buyers there are right now. So I think until we get a meaningful shift in the interest rate and mortgage rate environment, we're not going to see, certainly not the boom conditions that we saw through early 2020s, and it'll probably be a modest upswing with a lot of downside risk. 2024, there are varied expectations about the cash rate trajectory. So CBA sees it coming down as soon as Q1, right? ANZ is forecasting a modest shift potentially at the end of Q4. So I think the timing of the cash rate trajectory is pretty uncertain. One thing that has me kind of hopeful is that the inflation picture is unwinding pretty quickly. So we can be maybe a little bit more bearish about capital growth in property in 2024. But from an investor perspective, maybe it's time to look at better rental return and cash flow opportunities because the capital growth picture is a lot more uncertain right now. One thing we can be certain of is that even as rent growth starts to ease, rent values are generally much higher now. Vacancy rates are still low, just over 1% across the capital cities. And you certainly wouldn't have any trouble finding a tenant at the moment if you find the right kind of investment property.
Very good to know. We're going to take another break. See you on the other side with more from Eliza Owen. Welcome back to this episode of the Smart Property Investment Show. I am joined by Eliza Owen, Head of Research at CoreLogic Australia, and it has been a very insightful conversation so far. Eliza, I'm going to go a little bit rogue in this last section and ask you something that's probably for me a little bit more personal curiosity than maybe mainstream questions would be. But I'm very curious, given that you are working with data points every single day and making stories off the back of them and working out what this actually all means, are there any markets or data points that you're seeing right now that are either bucking trends or doing really, really weird things that it might be just interesting from an investment perspective?
Yeah, I guess maybe it touches on some things that we talked about earlier, but in terms of the strongest market performance over the past 12 months, we talk about national housing values still being down, although that decline is reduced to about 1% year-on-year fall. Markets like Mandurah in Perth, we're seeing that up 12.2% in value over the past 12 months. A relatively affordable area. And it's one that, it's just gone really strong this year. The gains have been about 9% in the year to date alone. We're also seeing areas of Adelaide, of course, that have been very resilient through the pandemic. So the Adelaide North suburbs, again, a very affordable area relative to what we're seeing across the rest of the country, with values up 10% in the past year. So I find it interesting that the strongest annual gains are kind of diverse, but you've got a lot skewed towards areas of Perth, South Australia, regional Queensland, and now Sydney's in the mix too, because Sydney is often kind of like a cyclical leader, at least on the East Coast. So it's almost like you've got these markets that are really still benefiting from the impact of COVID and what that's had on migration trends. And then on the East Coast, you've got the start of the recovery and almost the next phase of the cycle. So, I thought, those areas kind of bucking the trend and showing resilience to rate rises is quite incredible.
Some great insight there. I'm curious too, you've been doing this for a while now. You would have seen a lot of things happening in a lot of markets across the country. Have you ever seen a market behaving like the one we are seeing now. Obviously, we then go into the conversation of there's all micro markets and everything's doing different things. But is this kind of the macroeconomic factors that are playing in here? Is it something that you're used to or you know what to expect because you've seen it before?
No.
No. We love the honesty. You could have lied.
Yeah, I was certainly in the camp of like, well, property prices have got to keep going down as long as the cash rate keeps moving higher. But then you introduce things like this record net overseas migration position that we find ourselves in. That seems to have really offset the impact of credit conditions and lending. And, even the outgoing RBA governor, Phil Lowe, was sort of talking about how property is influenced by fundamentally factors outside of credit as well as credit, things like how we choose to tax property, how we organize ourselves, our infrastructure. So I'm always learning. There's so much to take into account. And yeah, I guess for me, it's just a matter of looking at the data as it comes through and trying to create the best data-driven explanations for that we can.
Eliza, it's always wonderful to chat. Thank you so much for taking the time. I know how busy you must be. Really looking forward to the next time already.
Thank you. Me too. Thanks for having me.
To everyone who is listening along, we hope you have enjoyed this episode. Like or review us on whatever platform that you listen to your podcast on. editor@smartpropertyinvestment.com.au. If you have any questions, subscribe for all the latest updates on our website as well. And check us out on social media, Facebook, Twitter, LinkedIn, and Instagram. Until next time, stay safe and well wherever you are listening from. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.